Hello and welcome to today's fast video, which is called Tariff War Relief. Told you so. Exactly last video, Saturday, the extensive one. But what I want to show you today is the article introduction from the extensive weekend analysis I write on my site daily. Here we go. The point is that within the positive headlines, one must be prepared for them in advance and view the signs not just through the geopolitics lens, but through the pain of the bond and currency markets that these inflict, whether it is on rest of the world or, as I had been saying already Thursday pre-market, on the US as well. So we had seen that originally working strategy suppressing yields in the States, backfiring, and 10-year easily making it through 450 again. So this is one of the key thoughts. This is opening half. The other half, in the hand of protection of client gains and securing them through correct calls, through being on the line always for them, comes through the great disconnect between consumer perceptions of the future and market perceptions of the future. And this ties in not just to the consumer expecting joblessness to deteriorate and inflation to go through the roof, almost mimicking early 1980s, but the point here it is that such a disconnect in perceptions presents great opportunities, namely that stocks had been beaten down too badly, and that had allowed me to call for clients to be long Wednesday pre-market and as well through the weekend, because even though looting spoiled the party a bit, we still go to the bullish gap and we still got more gains, whether they are swing or intraday clients. They all had been benefiting in stocks, and I'm limiting myself within this video only to the stock market, bond market and currencies. All the rest of what I do, precious metals, oil, copper and Bitcoin, stays with clients. And now, I want to say as well, note how well German and Chinese markets have been working great. Chinese especially, because that had been the area, single world area, that had defied the States and levied tariffs of its own. I had been as well already Thursday pre-market talking with clients that Europe is playing a swing role and that it is likely to strike some deals with China, while it waits for the 0-to-0 proposal with the States. Nothing is standing in the way of these reciprocal tariffs levied based on the trade balance, actually. Nothing stands in the way of these actually accelerating the shift to multipolarity as the US is reindustrializing and securing its own national security interests. As I say in the final paragraph, when in doubt, look at the great pacifier, the bond market, the bond vigilantes. It's irrelevant which money center had been selling US treasuries. In my view, it must have been coming mainly from Japan, which is a bigger holder than China, because China went from 1.4 trillion roughly in before the first tariff war. They went to maybe 800-900 billion dollars right now, so they still have a great stockpile, and in my view they have not yet predominantly touched it. And I have made the point that it's not about the yen carry trade or non-yen chunking or whatever soundbite you can hear pronounced all too often with finger pointed there. It's not been this. It's been rather Japan, and the important thing is that it is not shown in currency charts, as you will see further on. The point is that this is somehow showing less of a global need for US dollars. As I had been saying on the weekend, one part is the balance of payments when it comes to goods, and the other part is the capital account. So within the capital account, it indicates lower need for US dollars, and that's why the US dollar chart is looking the way it is. Therefore, the other side of this great pacifier, the bond market, is the currency market, where the US dollar depreciation is continuing, frankly, at a somewhat scary pace. But this is what it means for US stocks. And here you go, attempt to close the Sunday's gap, and off we go, grinding higher, and very soon we will be at those Wednesday jubilation tariff delay levels. So another call for clients that had worked great. Bond market. That's the chart that I'm watching because it's always the bond guys who have it right. The stock market is sometimes swinging from the very optimistic to very pessimistic levels, and usually now it is on the relatively optimistic, especially if you look at the sectoral view on a 5-day basis, which is the chart that I had been covering on Saturday. Thank you for the great reception of the long video. Thank you for liking these videos and subscribing to the channel. 1 to 3 year treasury segregate. You see, no real retreat in high yields, which is sending a message. Markets are cautious about what will be the next US moves when it comes to the Lutnick dialed back kind of tech truths. US dollar. Scary pace, right? Last 3 days. This one is Monday in progress, and it's not looking good. And my technical level of 100 to 101, roughly speaking, if you look at it in a horizontal perspective, that had been broken to the downside, and thus far this breakdown had not been invalidated. That would require quite a tariff move, quite a non-tariff move actually. So back to stocks for our chart. Here we go. We are almost at the gap level when it comes to the announcement of not really targeted and not really shallow, which had been another thing that I had predicted for clients before Trump Liberation Day. So here we go for our chart. Saturday's video features my comments as to the 5-day sectoral perspective, so make sure to review it, and you know which way this triangle in the making in my favorite volatility metric is going to be going next. Yes, it's going to be going down. My joint page will help you select what's right for you based on what and how you trade. Please do combine the intraday perspectives with quality daily analytics right into your mailbox delivered through my site. That's the best pack out there. My trading story, which you pretty well know already, and obligatory disclaimer. Talk soon again. Thank you.